Like the doji we discussed in video number 9, it can be either bullish or bearish depending on where it is within the price action. A bearish harami will occur at a market top, and a bullish harami occurs at a market bottom. For a bearish harami at a market top, the setup is an uptrend. That means the pattern must be preceded by a confirmed trend in the upwards direction. Sideways doesn't count. The first of the candles continues the upward trend. So with an uptrend, the candle is green, as the bulls continue to drive prices higher. The second candle has a small real body, which is fully contained within the range of the first candle's real body. That is, the range from the open to the close of the second candle is fully contained inside the range of the first candle's real body, or open to close. And as it states on the video, the second candle can be either colour. So a bearish harami at a market top involves a green candle continuing the uptrend, followed by an inside candle of either colour. In this case red, and in this case green. Both are valid. In addition, the candles may or may not have shadows. It has no effect on the validity of the pattern. Confirmation of the pattern involves price trading below the low of the pattern here. As with all candlestick patterns, more aggressive traders may be happy with price simply trading below the low. More conservative traders will want price closing below the low. A bullish harami is just the opposite, but let's go through the full definition just to be sure we've got it. The pattern must be preceded by a confirmed trend in the downwards direction. The first of the candles continues the trend. So with the downward trend, the candle is red as the bears continue to drive prices lower. The second candle's real body, or open to close, is then contained within the first candle's real body, open to close. And the second candle may be either colour, such as in the picture here where it's green, or here where it's red. And once again, the presence or absence of shadows above or below the candles means nothing with regards to the validity of the pattern. Confirmation of the pattern involves price trading above the high of the pattern here. As with all candlestick patterns, more aggressive traders may be happy once again with price simply trading above the high. More conservative traders will want price closing above the high. Let's look at the psychology or the sentiment of the pattern now to see who is in control, the bulls or the bears. The market is in an established uptrend. The bulls are dominant, or perhaps more desperate to get into the market, so they bid prices higher, creating another green candle here. Everything is looking bullish at this stage. The second candle changes things though. The bulls are no longer able to push price higher. However, the narrow range of the candle here shows us that neither party was overly dominant. Like the doji we discussed in the last video, the presence of this inside candle after the first bullish candle represents indecision. And as we know, this indecision could be a precursor to either a change to sideways congestion or a complete reversal of the trend. Note that I said that it could be a precursor to change. Indecision is not a guarantee of change. It's not the strongest of signals. We'll look at stronger ones in coming videos. So that's why we wait for confirmation through price trading below the lows. And of course the bullish harami at a market bottom is exactly the opposite. The dominance of the bears continues with the first red candle here. The second inside candle here shows indecision, a potential weakening of that bearish sentiment, a narrower range inside candle, indecision. And on receiving confirmation of the pattern through price trading above the candle here, we have a potential change to sideways congestion or a complete change to an uptrend. So why does this work? Let me try to explain a different way. Let's say you're trading the move down in this direction. On seeing the potential change of sentiment as it goes from completely bearish on the first candle here to indecision on the second candle, many traders will consider tightening their trailing stop. Now where's a great spot for that? Just above the pattern here. So if price then breaks through the pattern high in this region, not only will it trigger any new longs reacting to the pattern, but it'll also trigger the exit trades as short traders cover their position at this point here, which is also a trade in the long direction. So the force of the bulls entering a position and the bears exiting a position, both of which are a buy, could potentially be enough bullish sentiment to trigger the end of the downtrend and change to either sideways congestion or an uptrend. A common variation of the harami that you'll hear quite often is the harami cross. The first candle continues the trend, The second is a doji contained within the first candle's real body. The concept is the same. What initially appears to be continuation of the trend suddenly displays indecision and the potential for a reversal. Same for a bottom reversal, Harami and Harami cross, where the second candle is a doji. Let's look at a few examples. British pound US dollar Forex 5-minute chart. Violent downtrend move from a sideways congestion, as occurs quite often in the intraday Forex charts with an economic news release, leading to a Harami pattern at the bottom. Large red candle here, with following narrower range green candle here, in which the real body is engulfed by the preceding red real body. Confirmation through price trading above the pattern high, leading to a change to an uptrend. E-mini Dow daily chart, uptrend. Right at the top is a green bullish candle, interestingly with a bit of rejection of higher prices, followed by a small red body which has the real body fully contained within the real body of the green candle. That is a potential Harami. Confirmation in this example takes a couple of days, which could cause me some concern, but the bearish sentiment is shown again by this red candle here, which once again rejects higher prices indicated by the higher shadow, leading to a nice downtrend. They're not always perfect textbook examples, okay, which is why the key is to understand the sentiment of the pattern and how the tug of war between bulls and bears is playing out.